All right, Lobo, let's start by talking about the elephant in the room here, which would be inflation. Considering that the Fed wasn't expecting, or they weren't telling us that they were expecting this high of an inflation, at least they told us that they were not expecting it to continue going up, and they keep on telling us that. But anyways, that aside, do you think that we're now in for a bigger rate hike than what they promised us? So maybe 100 basis points or possibly even more in July?
Well, a lot of the talking heads on financial media are very focused on this question. So there's opinions are a dime a dozen out there. One of the Fed, one of the two Fed speak opportunities we had just yesterday was considering that very question. And the answer was, well, I still think 75 is appropriate, but I'm going to be data dependent and it could be more. So the Fed itself is saying that's on the table. We will consider a full percentage point increase. Doesn't mean that it'll happen. I think they are well aware that they failed. I mean, even Larry Summers, a Democrat, is saying the Fed, failed spectacularly in 2021 and is still, not his words, mine, but still, actually, he did say delusional once. He didn't say it in his recent comments, but they're still delusional about their expectations. They think they can get inflation back down to 2% with unemployment only rising to 4%. I mean, that is just not realistic. So I think that, we have a balance here of the Fed not wanting to cause problems by saying things that are too alarming, being limited in what they think they can say, and be caught between that and the reality that if they come across as too optimistic, too Pollyanna, nobody's going to believe anything they say. So you get this kind of testing of the waters. Oh, well, maybe 100, maybe not. We'll see. But the important thing here, I think, isn't so much whether they go with a full percentage point or not. The important thing here, to my mind, is that the soft landing scenario, which I never believed anyway, is clearly out the window. Even the mainstream cheerleaders for the economy have moved on in the financial media from, soft landing or not, to really how bad will the recession be. And what's interesting about this, the most striking thing about this is that we get a 9.1% inflation print, which is not surprising to your audience or my readers, but a shock to the mainstream. The projection was for maybe 8.8. And this came in higher than any mainstream economist polled, projected, or guessed, or imagined. So this the shock, 9.1%. What happens? People stampede into the dollar, right? How does that make sense? And you could say, oh, well, the Fed's going to increase interest rates. Your question, a 1% rate hike. Oh, that's got to be bullish for the dollar. Well, does it? I mean, the Fed getting tough on inflation the knee jerk is that that's good for the dollar, but it also implies this recession scenario, that the price to be paid for taming inflation is really harmful to the economy. How is that good for the dollar? So I think, it's an interesting time. I think that traders programmed to respond to data in different ways are, getting body blows and not sure what to do. The day of the news you're asking about, the inflation print, we saw an instant response in opposite directions for dollars, bonds, rates. And then it reversed within a couple hours. Like people say, well, wait a minute, let's think about this, right? And oddly enough, we saw the dollar and gold go up that day, but then over the course of the week, we saw the dollar mostly continue to rise, gold mostly continue to fall, to really interesting proportions. And there's a lot of directions we can go there. I'll let you ask the next question.
I was just thinking, I wasn't planning on really talking about that, but I was planning on talking about the soft landing. And I'm thinking, how do the retail sales come into your framework? Because some people are claiming that maybe we're now seeing signs that the Fed might manage that soft landing because we had an increase in retail sales. But I think you disagree with that because I saw you tweet something about it. So why don't you tell me more about that?
Sure. Well, retail sales increased, excuse me, month on month, 1%. Inflation increased month on month, 1.3%. And I know this isn't exactly apples to apples, but just think about that. people spent 1% more, but everything cost 1.3% more over the same time period. On average, everything cost. So they fell further behind. Spending was up. Doesn't mean anybody got more stuff or was better off. They were worse off. People are spending more to take less home. That's not a good thing. That's not positive at all. Sometimes it's tempting to explain things with some kind of conspiracy, and maybe there is one. I'm not saying there is or there isn't. My position is just it's not proven, but it's so tempting when you see something so boneheaded. How can nobody talk about this, or almost nobody? Maybe the Peter Schiffs of the world or others like that will pick up on this. But in the mainstream, nobody seems to care that inflation over the same period was up much more, 30% more than the spending. There's an obvious problem with proclaiming victory in the spending. The other thing, though, about the retail sales is that it was actually followed by consumer expectations. And I think that report was probably more telling. And maybe even though the talking heads didn't want to talk about sales losing ground to inflation, we did see a lot of waffling and the market's turning around and doing different things on the news. So I do think that traders were responding to different inputs. And the one that sort of capped off the week was the consumer expectations report. And even though it degraded marginally, it wasn't a big change. It was generally seen as not as bad as feared. It was a beat, right? But the most important number, I think, in there, and I did hear some people talking about this on Bloomberg, was that the consumer expectations for inflation, while higher in the nearest term, came way down, not just a bit down, way down, farther into the future. And that in my mind is really important. It says that it's not just the Fed, it's not just the economists on Wall Street. It says that the average person, now whether it's true or not, I don't know. I didn't collect the data, but what the data is telling us is that the average person out there is actually still drinking the transitory Kool-Aid, still thinks, or now thinks, oh, the Fed's getting so serious about fighting inflation. They think inflation's going to come down substantially. And this is really important because high inflation is part of the stagflation scenario that you and I have spoken about. It's part of the price outlook for all commodities. And it's very, very important for monetary metals. When people say, well, gee, we've got high inflation, what's wrong with gold? I think this is part of the answer. And not to go on too long in a different direction from your question, but I just...
No, do go ahead, because that's something that I was planning on asking, but we have all that. I think I'm understanding it, yet gold is actually moving lower. We have, was it the 5th week in a row that gold has closed in the red? We've now fighting the 1700 support, which, I mean, who thought that, right? So what's happening? Do talk about that.
I would say it certainly thought it was possible. When you and I spoke last, I said I didn't think that the stocks, the mining stocks, were leading the metals lower. And here the metals are lower. So one might say that I was wrong, but I don't think so. The context I meant was like 2012 to 2015 bear market, and the stocks led the metals lower back in late 2011 and early 2012. That's the context I meant. I still stick to that. I do not think that's what's happening. We are lower now, and this is part of it. I have 2 thoughts on this. One of them is where we segued right here, where the consumer expectations are very important for monetary metals, because that was a key ingredient in lighting the fire in the 1970s. It wasn't just stagflation equals higher gold prices. There's no economic law that says that. What made gold take off in the 1970s, and okay, I was just a kid at the time, but I was there, I saw it, I experienced it. I bought silver with my lawnmower and babysitting money because I participated in the psychology. And the thing is that prices were just going up and up and up. Everybody knew that it was better to buy anything durable you could today because it was going to be more expensive tomorrow. So that self-fulfilling, inflation begetting more inflation instead of inflation curing inflation, as some people are suggesting will happen now, was a powerful trend back then. People expected things to get higher, and therefore they saw and they felt and they were angry about the erosion of the purchasing power of the dollar. Now, the data is telling us that people don't believe that. They don't think that way. They think the dollar is going to stabilize. The powers that be are going to kiss the boo-boo and make everything better. I think that's fantastically naive. Maybe the alternative is too terrible to contemplate. Therefore, it's wishful thinking. I don't know. But it is what it is. And that is a powerful headwind for the monetary metals right now. That lack of expectation, that lack of belief that, the brown stuff really has hit the fan and things are going to get worse. The other one is related to this, and that is the strength of the dollar itself. Since you and I spoke last, the dollar has gone through the roof again. It has hit 20-year highs. I mean, we've got not just a 108 on the DXY, we've got euro dollar parity, which is a huge thing. A real shocker waker upper. Now, clearly that's a headwind for anything priced in dollars, right? Commodities are priced in dollars. Oil is priced in dollars. This is a direct and non-mysterious thing that if you have the dollar go through the roof, and not just, you could say it's not that much higher than it was 2 weeks ago, but it pierced resistance, shall we say, long-term, decades-long resistance. This is very important, I think, to the traders and their computer models and how they see things. So what we're seeing here is Brent Johnson's dollar milkshake thesis playing out in spades. He was right. It's happening right now. And I think it's exactly pretty much for the reasons he gave. And this isn't just, the Fed's going to raise rates 1% and that's going to be bullish for the dollar. This is also all the bad stuff happening in the rest of the world. The trouble in Europe, very specifically, that euro dollar parity is telling us something important. And it's not just the physical war and the physical issues on the eastern flank and the Nord Stream pipeline and the fears about it, whether it'll come back online or not. I think it's also the economic war and the basically holy shit awareness sinking in Europe that this is really bad. This is really going to cost us a lot. We are committed to going through the grinder here to fight for the right in this and be on the right side of history here, which I'm not criticizing, by the way. I have lots of friends in Ukraine, and I think it's terrible what's happening there. I'm just saying there's a price to be paid for it. And clearly it's dawning on Europeans now, or it's sinking in, how big that price is going to be, how long that's going to last, and what the economic consequences are. And it's not just Europe. We've got trouble in Japan. I mean, maybe Japan gets a bailout. We've got trouble in China. China just print flat. I mean, that was a big miss on the China GDP, not just from goals, but from forecasts, skeptical forecasts, Western skeptical forecasts. We're nowhere near as bad as the China GDP print comes out, which, China being such a huge consumer of commodities and metals is fairly explanatory to what we're seeing in the metals department.
You did see them import, I'm sorry if I'm being interrupted, but you did see them import 15% more copper in June.
And their exports went up too. Even with the GDP down, the last China export number was a record, actually. Right. So I think it's good you bring that up. I think actually you've got your traders out there looking at some of these numbers, plugging them into their models and trading accordingly. And they're driving prices based on their models, not necessarily on reality. The reality was, as you said, things are not as bad as that GDP number looks for commodities. I mean, you could be busier and make less money, right? If things are tough and your prices go down, you could actually work harder and make less money. Americans are seeing that right now to the tune of 3.6%. So you could see, economic contraction in aggregate, while physical demand for key commodities actually increases. It just depends on the price. If the price is down, right, you can still consume more, and the net effect looks negative. So I think this is where I was going to the good news. Everything we've said so far, it looks like rain on the parade here, Antonio. But the good news is, I think a lot of the damage done to commodities prices is based on these traders and their models and looking, we've got recession, we've got China in trouble by these problems. sell commodities. But the reality is that, well, one, you've got China, I do think, joins the great reopening at some point. I mean, there's still COVID zero policy problems. The Q2 GDP print is backward looking, and things are already visibly better. It's not done yet in China, but things are already visibly better now than they were. The Q2 number includes some of the worst of the Shanghai lockdowns and the Beijing lockdowns and other lockdowns. That's not happening now. So we know it's already better now. So I think we're going to see much more demand out of China going ahead. I suspect that for face-saving reasons, China will never officially abandon the zero COVID policy, but I suspect that for real reasons and the need to deliver GDP growth, we'll probably see some softening or redefinition of what that means and more growth there. There's potential for surprises to the upside in Europe too. The war is not going to end anytime soon, I don't think. Could be wrong, but I don't expect an end to the physical war soon. And even if it ends without regime change in Russia, I don't think the economic war ends soon. So that's a tough nut to crack. But reality does matter on both sides of the new Iron Curtain. And if Putin does turn the gas back on after the maintenance is done, and if they actually do turn Nord Stream back on, I think that could be seen as a positive. It may be that the euro has overcorrected compared to the dollar in the near term. So that could be a headwind for the dollar, which would be a boost for commodities. But the biggest thing is, going back to our first question and the start here, I don't think the Fed really has a grip on the situation. I do think they're still way behind the curve. I think it's a mistake to think that the Fed is on the job and it's going to fix things. Everything's going to be fine. Everything's not going to be fine. The knee-jerk assumption is, oh, recession, bad for commodities, and maybe even deflationary and therefore bad for gold and silver. I think that's wrong. I think the same reasons the Fed's policy is not adequate to solving the problem are actually bullish for commodities. Like, they can cause a recession without actually really taming inflation. I mean, maybe it doesn't stay at 9%, but it still stays high. And you have a stagflation that's not just weak growth and inflation, but no or negative growth and high inflation. And if I'm right about that and people wake up to that reality, I think it reignites a fire under commodities. Like, that's when people really start hearkening back to the 70s or maybe the 40s, as Lynn Alden likes to say. And people reconsider. I mean, their assumptions get reconsidered. That's what needs to happen. And especially as long as people keep quoting futures contracts as the price of gold or silver, those traders those futures traders need to start modeling differently. Reality does matter, and I think they will, but they haven't yet. And when they do, I do think that changes the dynamics. Ultimately, reality does matter here, Antonio. And I do think the world will be consuming more, not less, raw materials going forward. I think that between the great reopening and the green agenda, that's very bullish, particularly for new energy minerals. And I think the overall situation, the geopolitical situation, the safe haven demand in the world, plus the real causes of inflation and why it remains high, I think that's bullish for gold and silver as well. So I do think there's a mental reset coming. And maybe the best news right now, I'm giving you a sneak preview of today's digest, will be going out soon. The best news is that the very nearest term, right away, that reset hasn't happened yet. So I think we're likely to see more buying opportunities, maybe some extreme buying opportunities in the nearest term. Now, if you're long already, that may not sound like good news, but if you have any cash to deploy at all, that actually is, I think, very good news, because I do think an extreme buying opportunity in the near term, without getting too crazy and hypey or whatever. I mean, this is the stuff that makes careers or makes fortunes, if you will. I'm not going to promise that. I just think we have exceptional potential for extraordinary gains based on what's going to happen this year right in front of us.
What do you mean you're not going to promise me returns? Aren't you a newsletter writer?
That's right. I'm supposed to say it's going to the moon. But that's an important point, actually, Antonio. Even if you think about it, I have been saying that for some months now that I see potential for downturn. There hasn't been a market crash that I thought was in the cards, but I was right. I have been telling people I'm not buying for several months now. And that has turned out well. Like whatever happens next, like if you say, no, Lobo, you're wrong, it's bottom now, it's so oversold now, I'm going to buy now. Right now, you have maybe a 50% lower price than you would have 2-3 months ago on some of the best stocks in the sector. So my caution here has already paid off. So for whatever it's worth, I'm still cautious, but I'm excited. I'm cautious, but not because I think everything's going to go into a bear market for commodities for years and years ahead. I'm cautious because I think the odds are high that we'll have a terrific buying opportunity. If anything, I think the odds favor stocks in general equities to go into a bear market. We've had a bull market for stocks since the early 1980s. If you think about it, I think it's overdue for that to go in reverse. I could easily see the 20s being like the 70s, in that being a long, protracted bear market for stocks. The top is in, and they may survive, they may not crash, but they may just grind lower for years and years ahead. That actually is consistent with the economic outlook that I see ahead.
Well, you know what they say, copium only gets you that far, and then eventually you end up hitting the brick wall of reality, right? It's become a meme, but it's also true. That's why it's a successful meme, I guess, as most of those memes. And I guess I've been trying to look for a bear thesis on commodities, and what I can find, and when I say find, is mostly asking people to give me one. What experts would give me is a short-term, trading view on things, basically, like what's going to happen in the short term, and the prices may fall, but nobody gives me like an actual fundamental bear thesis on commodities, I guess, because that's inexistent. And so the way that
there is one. That would be the Harry Dent view. He's been fairly consistently calling for a deflationary recession since 2007 or 8 or something, at least since the crash. And he's been famously calling for gold to go down to 700. I think he may have changed the target now. It's funny because he agrees with many libertarians like me in criticisms of the government policies, but he thinks, and has thought for a long time, that it's going to result, the real damage being done to the real economy takes us into a recession, or Doug Casey's Greater Depression. But where Doug thinks that will be bullish for real things like commodities and gold and silver, Harry Dent thinks that the deflation would be bearish for everything. And so I don't agree with this, but if you're asking for a bear case, that would be one. A bear case would be that the powers that be have really lost it. The brown stuff is about to hit the fan. The world is not just going into stagflation, but into a even greater recession, if not into actual depression. And people are just, the economy just, goes into fetal position. And if that happens, it's very hard to see, even with the Green New Deal, it's hard to see commodities in large not suffering. Whether gold and silver suffer, I think remains to be seen. An important difference here, and going back to the 40s, an important thing to keep in mind here is that, okay, Roosevelt, he confiscated the bullion in the 30s, but nominally, at least, the dollar was still defined, pegged to, and foreigners could exchange it for gold. So in the 40s, it's a mistake to think of the price of gold in the 40s. There was no price of gold in dollars. The dollar was defined as a certain amount of gold. So the dollar was gold, or gold was the dollar in a certain way. So after 1971, Nixon shock, that goes completely away. The dollar isn't even theoretically defined in terms of gold. It's an abstraction. It floats on its own. So what I'm saying is, it's dangerous to harken back to the Great Depression. If that's the model, if that's the bear case, you can't look at what happened to gold in the 1940s and say, oh, well, that's what's going to happen now. Because then, right, if you have deflation, that means things got cheaper in dollar terms, and the dollar was gold. So actually deflation was good for gold then. in today's world of fiat currencies and the dollar not being pegged to gold or related to gold at all, things could be very different. But my answer to this is the Friedman answer, always and everywhere, monetary phenomenon. And I do think the record-breaking money printing done in 2008 in the wake of that around the world has not yet been paid for. The powers that be kicked the can down the road. And now the even more gargantuan money printing since the COVID-19 shutdowns, I think, makes that untenable. So if the powers that be lose their grip and we get this big global crash, I actually think that will be terrible for all fiat currencies. And I think that real money will soar in value. Do I know this? Can I promise it? No, but that is what I think would happen in that case. But my base case is actually not this. I think that if something like this even starts to look like it'll happen, I think the money helicopters go out again, the money fire hoses, bazookas, choose your metaphor. I think the powers that be panic, they pivot around the world, and they will hit the problem with unlimited amounts of money to try to paper it over again. Whether that works or not, I don't know. But that's my expectation. I think a reflationary boom is much more likely than the next big economic turn being an actual depression.